Welcome to another episode of Business and Wealth Australia podcast. And I have with me Nick Walter from Walter Wealth. Welcome, Nick.
Thank you, Alesha. Great to be here again.
Yeah, thank you so much. In the last episode, we talked about getting to know you a bit more and the kind of people you help through your business at Walter Wealth. Today, I'd love to know more about the markets. Let's talk about the AI stuff, the bubble, and what happened in April. So let's kick off with talking about the April dip and what did you think of that?
Well, the April dip was all Trump and tariff related. It caused a lot of concern. But I think if we think about April, we should probably think back to Trump's earlier presidential term where markets really just went up, 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 up. And I think investors were a little sleepy at the start of this presidency, thinking that might happen again. Trump had talked about tariffs, but what he did on what he called Liberation Day was a little bit radical. And he imposed very significant tariffs on allies and enemies, really everyone. He was criticized for the formula that he used to create the tariff levels, and markets got very scared. Markets fell quite heavily in the following days, and the world was in a little bit of fright, so much so that Trump then put a 90-day pause on the tariffs, and all of a sudden markets breathed a sigh of relief. So that was a bout of volatility that the market wasn't really expecting. A trade war was really started that day, and markets were on notice.
That's totally fair. Sorry, I just wanted to add that this is general advice and not financial advice in any way, shape, or form because we don't know anything about people's personal circumstances. So we'll have a disclaimer as well. So I just thought I'll add that in audio as well. But going back to the tariffs and trade war, do you think this will continue? And how long do you think this will continue for?
Yeah, well, he hasn't stopped talking about tariffs and imposing new tariffs since Liberation Day. And I think really the big concern at the time, which still exists to some extent, that concern is that businesses will fail and consumers and businesses will lack confidence. We've obviously seen some geopolitical tensions and a declining US reputation as a result of not just the tariffs, but Trump in general. And really what markets are worried about now is just the general uncertainty and the chaos around the Trump presidency. Every day, every week, we seem to get a new topic that creates a lot of consternation in the US and in markets. And how that sort of plays out in the economics is we've seen an increase to the unemployment due to sort of hiring hesitancy. We're seeing higher inflation. We are seeing weaker confidence. And obviously that amounts to huge political upheaval across the US.
Yeah.
But I will say, Alesha, that the general economy, global, US and Australia, remains healthy. We're seeing that employment, whilst it might be going up in some regions, it's still historically very low. So employment remains strong. Inflation still remains moderate. And the growth of most Western countries in the world is still improving. So all in all, we've still got fairly favorable conditions. And if we could add to that, perhaps, credit markets remain stable and corporates are improving their earnings. So really what we've seen is this chaos around the Trump presidency play out. But I think the conclusion might be that Trump loves the attention. He loves the chaos. He loves the media, but his impact on markets and his impact on the economy has so far been very mild and in fact maybe even positive. So I think for people, there's a lot of people out there that are very anxious and nervous about what Trump's impact will be.
And how do you think that's impacting the local market in Australia for us?
Yeah, well, what happens globally does have a impact here in Australia. Everybody's invested through their super. Every Australian employee is an investor. The super funds are very good at taking advantage of global markets. And so every superannuation investor would have some exposure to what's happening overseas, some exposure to what's happening in the US. So we do need to be mindful of that. But we don't have the tech sector that we have in in the US, and we've got much more conservative companies and conservative sectors here in Australia. Less growth, perhaps, than what we're seeing overseas, but certainly more income. But as an example, Alesha, the NASDAQ index in the US, which holds all the technology companies, that's gained more than 20%.
Oh, wow.
Over the last 12 months. It's gained a little more than 20%, whereas the Australian market, in comparison, is only up 9%. So we haven't perhaps stretched as far as the US has. And so we're a little bit more insulated from Trump, from the tech sector, but we'll no doubt feel the ripples of any correction from over there.
And I don't know if you agree or disagree, but I've noticed that the Australian market is really led by the financial services sector, like your big banks and that kind of thing, versus the US market being led a lot more by the tech innovation and that side of things.
Yeah, without a doubt. I mean, 8 of the top 10 global companies are now US tech giants, whereas in Australia, 4 of the top 5 companies are the major banks. And so what the major banks do and how quickly they may be able to grow can often determine how much our share market will grow. We are very much dominated by the major banks, and then the major miners and the major supermarkets. They make up a very large part of our index. So we want all of those companies to grow, but they'll never grow to the same extent as the technology giants are growing in the US.
That's fair enough. Going back to the Australian market, and the fact that banks have a massive part to play, they run a lot on the inflation data and the RBA cash rate, and which is based off of the inflation data. How does that play out in the share market? Because it's quite clear in the property market, you sort of go, okay, if, for example, rates go down, then, property boom comes in. But how does that impact the share market?
Yeah, okay. So over the last 12 months, we've seen inflation come down, 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 down. And the most recent inflation print was a surprise because for the first time in about 3 years, it actually went up. But naturally, as interest rates come down, people start to feel a little bit more financially healthy. And that does feed through into higher property prices. But it's the same for the Australian share market as well. We see that the share market rallies when interest rates go down as well. And I just encourage people to focus on the medium term and not get caught up in the noise, not get caught up on the day-to-day. What is the market doing this week? What is the Reserve Bank doing this week? What is inflation doing this week? I think overall, markets remain stable. Corporates are growing their earnings, and both the property market and the share market has an opportunity to grow.
Yeah, that's a fair point. I want to understand what you consider medium term to be. And I'd like to explore that a little bit as well.
Yeah, so the short term is really week by week, month by month, and for some people, even day to day. The medium term is really 2 to 3 years. And then the long term is more 3 to 10 years. So, the first step for people is to take that investment step, and then if they can, hold for the medium term, and then they'll start to see the benefits, and certainly even more benefits over the longer term.
Let's gears slightly. And I want to talk more about the US market, what's going on in the US market. I listen to a lot of podcasts and I read a bunch of news as well. And I've been listening to people talk about the doom and gloom of artificial intelligence, potentially talking about the AI boom. So what is your analysis on the AI boom?
Oh, you're right, Alesha. There is so much talk about artificial intelligence and what it's going to do for our lives for the next 5, 10, 20 years. And what I can tell you is there's a small number of companies in the US, the tech giants like NVIDIA, like Google, like Microsoft and Meta. They have spent $360 billion just in the last year in a race to commercialize AI technology. So this is real. It is real because that money gets spent and that money gets passed through to a range of corporates, a range of sectors within the economy. It really is a capital expenditure boom. A lot of people are calling it a bubble. I won't call it that just yet. It's certainly a hope bubble, and we really wait to see who can commercialize the AI technology for their own benefit first. There are definitely going to be winners and losers in all of this. And if we just sort of think about it for a minute, there are companies that are supplying the computer chips that run the AI models. There are companies like Microsoft that provide the infrastructure for the data centers and for the AI models, but they're all in a race to try and commercialize that technology for their own benefit.
Yeah, that's totally fair. But do you think that there is a similarity of this AI boom with the dot-com boom or the bubble that happened 25 or 20 years ago?
Yeah, certainly in terms of hype, there are some definite similarities. And similar to that 25 years ago, we didn't know who the winners and losers were going to be. And it probably took 5 years. And at some point over the next couple of years, companies will start to put their hand up and show evidence of how they are commercializing their technology. And some people will put their hand up and say, we have not been able to commercialize the technology. And that's exactly what happened 25 years ago. And companies at the time were expected to be able to commercialize it instantly, and they just weren't. So we know that these things don't happen overnight. We know that it will take time. And so likewise, it'll take time for the winners and losers to be identified. A couple of things to think about. Right now, 8 of the largest 10 companies in the world are technology companies. And think about every single individual around the world pays a subscription model to either a telecommunication provider, a cloud computing provider. Everything we do involves computer chips. Everything we do involves technology. At the very forefront of AI is a company called NVIDIA that makes the best computer chips in the world. They now have a $4.5 trillion valuation, which is extreme. But they make 80% of the world's best AI chips. And they've got a 55% profit margin. So an incredibly profitable company, but an incredible valuation comes with it. And as I said, it's ultimately the consumer that pays. And right now, we're not seeing consumers pay up for it. We are starting to see companies like Microsoft that are offering their subscription services with and without AI technology, their Copilot technology. So whether people are willing to pay that extra $10 a month or $100 a month, or they're willing to pay, or corporates are willing to pay an extra $100,000 to get the better computer chip, that's still to be seen.
Yeah, and I think ChatGPT itself has also released a premium version versus a free version. So, but I wonder how profitable that is, because I think Microsoft owns it. But that's just a bit of information that I have on ChatGPT. But in terms of people wanting to mitigate risk or manage their risk in terms of AI, what are your thoughts about that?
Yeah, so there's a lot of talk about the AI bubble. And if people are very nervous about investing into that bubble, I say, look, technology is driving this world. Some say that we're in the third wave of a digital revolution, where the first wave was the internet, the second wave was mobile phones and social media, and then the third part of it is AI and what we see from AI in our day-to-day lives. So I am always encouraging people to have some exposure to technology, but the valuations of these technology companies have pushed and pushed and pushed to an extreme. So if that bubble bursts, the whole economy will feel it. Interestingly, perhaps minus the banks, because these big technology companies actually don't have much debt. They've stockpiled cash, billions and billions of US dollars in cash for decades, such that they don't have a lot of debt. So it won't bring down the banking system, but it will bring down the economy to a certain extent. So what I encourage my clients to think about is, where would we invest if we didn't want exposure to that bubble or that sector being US tech? And if we look at Australia, if we look at Europe, if we look at places like Japan, valuations are much more conservative, but they're still offering diverse industries that are growing at good rates. So there are good returns to be made outside the US market. and perhaps insulated from significant risks. When a correction comes is very hard to predict. It won't necessarily just be the share market. It'll be an economic event that might determine the bubble bursting. But in the meantime, whilst we're faced with this bubble, I tell people there are lots of other ways to make good money. And outside the share market, we might even consider property or infrastructure or private equity, which is all those sectors, all those asset classes are far less volatile than shares. So there's a range of different ways to make money and make good returns. It doesn't all have to be about the share market and technology. It's always about a balance.
That's really good to hear. But I guess with everything, there comes with its own risk. For example, property would come with a leverage risk, which is why it's so important to speak to a financial advisor to be able to guide someone or one to be able to make the right decision for them particularly. So, Nick, if someone wants to get in touch with you, what would be the best way of doing so?
Look, I'm very contactable by phone, my website. People can look up Walter Wealth Advice. My contact details are there. I'm always happy to take phone calls, happy to have a question and answer chat, find out what people are looking for and whether I can help, whether I can make any positive impact.
Fantastic. I'll also leave a link in the description of the show notes, so anyone who's listening and would like to contact Nick can do so.
Fantastic, Alesha. Really, really appreciate it.
No worries. Thank you so much, Nick, for joining me today. It was fantastic to hear about the US stock market, the Australian stock market, and also your thoughts on the AI boom at the moment. And hopefully we'll get to hear you soon.
Would love to. Thanks, Alesha.
Thanks, Nick. Bye-bye.
Bye.
General advice disclaimer. This podcast has included commentary from Nick Walter, licensed financial advisor, authorized representative number 103557. Nick represents Walter Wealth Advice Pty Ltd, corporate authorized representative number 1308116, licensed by Alliance Wealth AFSL number 449221. Information included in this podcast recording does not take into consideration your objectives, financial situation, or needs. Consider the appropriateness of the information before acting and seek professional advice.